Hi, my name is Pieris Marcu, and I would like to welcome you to our first quarterly tax update for 2016, brought to you right here from the doorsteps of the Ministry of Finance in Nicosia, just a few days following Cyprus's successful completion of the European Stability Mechanism Program for financial assistance. Back in March 2013, the Euro area countries, together with the IMF, agreed to a package of financial assistance of up to 10 billion euros for Cyprus. Thanks to a better-than-expected economic recovery, private investors' participation in bank recapitalization, and a return to market financing, the full amount was not needed by Cyprus, with the ESM and the IMF distributing just 7.3 billion euros out of the 10 billion that was approved. So I think congratulations are in order to our Minister of Finance and his team for turning the economy around and creating again a prosperous outlook for the future. In fact, we are not just celebrating the country's successful completion of the program, we are also celebrating the first anniversary of our tax webcast, which was brought to you for the first time in April last year. So congratulations to our Deloitte Cyprus tax team and keep up the good work. In today's webcast, we will look at recent developments in local tax legislation during the quarter ending 31 March 2016. We will update you on a new tax treaty signed during the period and briefly cover some important international tax developments. We will close off today's webcast with a quick reminder of the tax deadlines coming up during the next quarter. Let's start by looking at developments in local tax legislation. In fact, we had no tax legislative changes during the first quarter of 2016. However, there are some important announcements and developments during the period. Let's start by looking at some developments around the notional interest deduction. If you recall, in July 2015, the Cyprus tax law was amended, introducing a notional interest deduction. The notional interest deduction, if you remember, is calculated by multiplying the new qualifying equity with a reference rate. And the reference rate is the yield of the 10-year government bond of the state in which the new equity is invested, plus a 3% premium, having as a minimum rate the 10-year Cyprus government bond yield plus a 3% premium. To assist the taxpayers in the notional interest deduction calculation, the tax department circulated the following 10-year government bond yields as at 31 December 2014, which are the rates to be used in calculating the NID in the tax year 2015. Furthermore, as the NID is a relatively new concept in Cyprus, the Cyprus Ministry of Finance is currently in the process of drafting a circular that provides more details regarding the application of the NID provisions of the income tax law. The circular is expected to be issued shortly, so watch this space for future updates. On the intellectual property regime, the Cyprus Ministry of Finance is currently in the process of amending the income tax law provisions regarding the intellectual property tax regime in order to be in line with the recommendations of the BEPS Action 5 report issued by the OECD. Once the discussions are concluded, we expect that the amendments to the existing income tax provisions would be released along with the relevant regulations explaining how the new IP tax regime should be applied. The intention of the Ministry of Finance is to provide the maximum transitional provisions for the current IP regime before this is phased out. The Common Reporting Standards, CRS, has come into effect in Cyprus and in most EU member states from 1 January 2016. For exchanges between EU member states, the European Council adopted a relevant directive. The purpose of this directive is the implementation of the global standards on automatic exchange of information within the European Union. On the 2nd of March 2016, the Council of Ministers approved the draft legislation amending the existing administrative cooperation in tax matters law and harmonizing it with the EU directive, which has been submitted to the House of Representatives for voting. The law is expected to be voted and published shortly. On the 4th of February 2016, the Tax Department issued a notification clarifying the imposition of special defense contribution on interest income. Every individual who is a tax resident and domiciled in Cyprus who receives or is credited with an amount of interest, except from interest received from government savings certificates or bonds, or interest earned by an approved provident fund or the social insurance fund, is subject to the STC at the rate of 30% on the interest received or credited. According to this notification, an individual whose total income, including interest, does not exceed the amount of 12,000 euros has a right of refund of the special contribution withheld on interest in excess of the amount of 3%. A person may claim for repayment of tax within 6 years from the end of the year of assessment to which the claim relates. Finally, the tax department is planning to upgrade its services with the aim of simplifying its process and better service the taxpayers. In this respect, on the 17th of March 2016, the tax department issued a tender for the acquisition of a modern data processing system. This system will work to complement a draft bill for the simplification of tax processes, which includes a provision for an online payment service as well as additional measures to benefit taxpayers. This bill is expected to be submitted to the Parliament during the year. Although no new tax treaties have been signed during the first quarter of 2016, there was a new treaty that was signed on the 30th of December 2015, for which an announcement followed in early 2016. Let's have a look at the details. On the 30th of December 2015, Cyprus signed a tax treaty with Ethiopia. This is the fifth tax treaty that Cyprus has signed with an African country. According to the tax treaty, the maximum withholding tax rates are as follows: dividends 5%, interest 5%, royalties 5%. The provisions of the treaty will come into effect, in the case of Cyprus, on or after the 1st of January following the date upon which the treaty enters into force, and in the case of Ethiopia, on or after the 8th of July following the date upon which the treaty enters into force. For the international part of this quarter, I will briefly update you on the developments within the European Union, especially with regards to the anti-tax avoidance package announced in January this year and the rulings reviews on state aid. In addition, some favorable developments in connection with the Russian Deoffshorization rules are worth mentioning. Let's have a look at the EU anti-tax avoidance package. So what is the issue? In accordance with the European Commission, some companies use aggressive tax planning techniques to exploit loopholes in tax systems and mismatches between national rules to reduce their tax liabilities. This undermines the fair burden sharing amongst taxpayers and means fewer revenues for public financing needs. As a result, on the 28th of January 2016, the European Commission released an anti-tax avoidance package that contains proposed measures to prevent aggressive tax planning, boost tax transparency, and create a level playing field for all businesses in the European Union. According to the European Commission, in order to ensure that taxes are paid where the economic activity takes place and to eliminate profit shifting, it is important to act on various aspects such as strengthening domestic tax rules, addressing tax treaty issues, enhancing transparency, and building a common approach towards third countries. The tools used are the two legal binding directives, the Anti-Tax Avoidance Directive and the Revised Administration Cooperative Directive, a Commission recommendation, and a Commission communication preventing together aggressive tax planning within the European Union and external base erosion threats. The package is structured around 4 key initiatives which are accompanied by the Chapeau communication that clarifies the context and objectives of the package, as well as by a new study on aggressive tax planning, which looks at the main channels used by companies to avoid tax. So what are the next steps? The 2 legislative proposals of the package will be submitted to the European Parliament for consultation and to the Council for adoption. The Council and Parliament should also endorse the tax treaty recommendations, and Member States should follow it when revising their tax treaties. Member States should also formally agree on the new external strategy and decide on how to take it forward once it has been endorsed by the European Parliament. Currently, the Netherlands hold the presidency for the Council, and an ambitious EU BEPS roadmap on the 19th of February 2016 was announced. The roadmap sets out plans to move forward with previous European Union proposals, such as reaching consensus on the Anti-Avoidance Directive and introduction of the OECD BEPS minimum standards for country-by-country reporting in the European Union, as well as future efforts on areas relating to BEPS. On the 8th of March, the Economic and Financial Affairs Ministers of the Member States have reached a political agreement on the automatic exchange of country-by-country reporting information subject to UK parliamentary scrutiny. The European Parliament is being consulted on the proposal, and the final adoption by the Council is expected to take place in May. As part of a separate work stream, the European Council is currently finalizing its impact assessment on public country-by-country reporting and will present its proposals later this month. Presently, the international framework for exchange of country-by-country reports between the tax authorities is represented by the Multilateral Competent Authorities Agreement stipulating for automatic non-public exchange. The latest news on the rulings review update is that on the 11th of January 2016, the European Commission concluded its in-depth investigation of Belgium's excess profit tax ruling system. The decision held that the rulings constituted unlawful and incompatible aid under EU state aid rules, and therefore the Commission ordered Belgium to stop applying the rulings and seek to recover the full unpaid tax from the beneficiaries of the rulings. The European Parliament has adopted a non-binding resolution that money recovered in state aid cases should be transferred to countries hurt by the illegal tax deals or to be placed into a general EU fund. Finally, the appeals by the governments of Luxembourg and the Netherlands to the EU General Court against the decision of the European Commission that their tax rulings on transfer pricing arrangements for Fiat and Starbucks respectively constituted incompatible to EU state aid rules have been made public. A brief update on the Russian deoffshorization rules and some good news. Under the Russian deoffshorization rules, the first reporting of CFC income will be due in 2017 with respect to income received by the CFC in 2015. On the 15th of February 2016, the Russian president signed a number of changes to the legislation relating to taxation of profits of CFCs and foreign organizations in Russia. According to the amended CFC rules, it is now possible to calculate the CFC income on the basis of audited financial reports if one of the following conditions is met. An unqualified auditor's report of the CFC's financials has been submitted by the taxpayer, or the CFC is a tax resident of a foreign state with which Russia has a double tax treaty in effect and with which Russia exchanges tax information. The CFC income should be calculated based on standalone reports prepared in accordance with the standards stipulated by the laws of the CFC's jurisdiction. If the standards are not stipulated, either IFRS or the standards acknowledged by stock exchanges or depository and clearing organizations should be used. Therefore, if a CFC is located in a jurisdiction with which Russia does not have a tax treaty, then if the company can furnish a clean audit opinion on its financial statements, this may be used for CFC reporting purposes. We will close off today's webcast with the dates to watch out for during the next quarter ending 30 June 2016. On the 30th of April is the manual submission deadline for the 2015 personal income tax return by salaried individuals whose gross income exceeds 19,500 euros for the tax year 2015. We also have the deadline for the payment of the first installment of the premium tax for insurance companies, life business, for the first quarter of 2016. 30th of June deadline provides for manual submission of the 2015 personal tax return by individuals who do not prepare audited financial statements if their gross income exceeds 19,500 euros for the tax year 2015. We also have the payment deadline of the tax balance for the tax year 2015 through self-assessment by all individuals excluding those individuals who prepare audited financial statements. We also have the payment of the special defense contribution on rents, dividends, or interest received from sources outside Cyprus for the first 6 months of 2016. Finally, 30th of June is the payment deadline for the second installment of the special tax levy by credit institutions for 2016. This concludes our webcast for today. If you have any comments or queries of any of the items discussed during this webcast, please email us on cyprustaxwebcasts@deloitte.com. Thank you for watching and see you in July.